Hi, I'm Jimmy. In this video, we're going to walk through a quick review of where the US economy stands today using different economic indicators. And as we might have guessed, it's not looking too great right now. But frankly, it was a little bit better than I was expecting. The goal here is to see if we can get enough of a big picture view of the economy so we can make better investment decisions and ideally get us closer to our personal goal of achieving financial freedom. Okay, so let's jump in. So this is the Baltic Dry Index. Now, I showed this particular chart in our last video. We do this video every month. And just so we're all on the same page, what this index does is it measures the cost of shipping raw materials. And the index measures the cost of shipping for the three different ship sizes, the three largest ship sizes. 40% is Cape size, that's the biggest ship, then 30% for the Panamax, and then another 30%, the other 30%, for the Supramax. Now, I do want to point out that this index tracks the price of shipping, generally shipping raw materials. So what we're looking for is the broader trend. And in theory, these lower prices that are happening simply because there's not many raw materials being shipped, therefore no demand, hence the price of shipping goods falls. But if we were to update this chart as of yesterday, well, we can see that there's been a drastic jump in the Baltic Dry Index. This implies that the demand for shipping raw materials has begun to increase a decent amount. In fact, it jumped from about the level of 500 to more than 1,500, so that's more of a triple. Now, this is logical if we think about it. China has seen much more activity. The US has begun to open up, so there's more activity happening there, and a bunch of countries around the world are showing more and more manufacturing activity than they were, let's say, just a month ago. Now, where I think it makes sense to keep a close eye on this particular economic indicator, for now, I think we've got to say that this seems to be a point for the bulls. So when we jump over to our scorecard, here we're going to add 1 point for the bulls. Okay, now the next indicator is a somewhat related indicator called the ISM Manufacturing PMI indicator. Now, I say it's related because in many cases, manufacturing will include the purchases of raw materials. So we can probably guess that there's going to be some turnaround over the past month. And when we switch over to that chart, well, we can see that yes, the ISM manufacturing indicator did show at least a minor jump. Now, I think it's important to point out that this number is a monthly number. So that last number that we see is as of the end of May. I'm guessing the June number will be better, but we won't know for sure until the next number comes out. I believe the next number comes out on the 1st of July. Now, here's how we read this particular economic indicator chart. The most important level here is 50. Anything above 50 means that manufacturing is growing. Anything below means that the manufacturing sector is shrinking. So right now, the ISM manufacturing indicator is sitting at a slightly above 43, which means that yes, it's better than the 41.5 from last month, but this still indicates negative growth. So while I think that this is improving and I'm hopeful that the turnaround continues, for now, this economic indicator is showing negative growth, which for me is a negative thing. And clearly, I think that it makes sense to give this point to the bears. So we can see on our bull-bear scorecard here that the bulls and the bears each have 1 point. Okay, now let's jump over to the job situation. Our first economic indicator is the initial jobless claims. And we can see that the coronavirus has destroyed the job situation. During this spike, since the start of the coronavirus, more than 47 million jobs have been lost. Now, I do think it's a good sign that the spike appears, there was an initial spike and that trend appears to be heading lower, but these are still way off of the old range. So clearly, this is going to be a negative point. This is a point for the bears. But before we jump back to the scorecard, I think it makes sense to also look at unemployment numbers. So one of the key differences between unemployment and initial jobless claims is the frequency that they're reported. Initial jobless claims are reported weekly, and the unemployment numbers are reported monthly. And at least partially because of that, initial jobless claims can do a better job of being a leading economic indicator than unemployment is. So if we saw headlines about the 3 million new jobs that were created, well, we can see that in the unemployment number. Initial jobless claims does not account for when these people get rehired, only when people get laid off. So now we can see that for unemployment, it's obviously a good sign that there was a pullback in that number. We want lower unemployment numbers. But I think from a research standpoint, from an economic standpoint, the real question is, how fast does this happen? How fast does unemployment get better? Because we're going to need that unemployment rate to drop real fast for the economy to really boom. With that being said, when we switch over to the scorecard, here I think it makes sense for both jobs indicators to give those points both to the bears. Okay, our next economic indicator is housing starts. And when we look at this chart, by the way, housing starts is how many new houses are being built. When we look at this, it's a monthly indicator, and we can see that they got creamed when the coronavirus shutdown happened. And this is logical. But much like unemployment or manufacturing, we can see that in the most recent month, there was a bit of a jump. So once again, while I think this is a positive sign for housing and the broader economy, it's still quite a negative thing since the housing starts number pulled back so much. So the recovery is going to have to be a lot stronger than just this most recent month. Now, once again, this is a monthly number, so it's very possible that we see a much bigger jump for the month of June. But for now, over on the scorecard, I think it makes sense to mark this down as a point for the bears. Okay, the next economic indicator may not be a surprise at all when we think about it. Next up, we have consumer confidence. Now, much like the other economic indicators, consumer confidence showed a big drop-off, followed by a somewhat decent bounce in the most recent number. And obviously, higher is better for consumer confidence. Now, I say that this is likely not a surprise since everything seems to be moving together at this point. Nearly every indicator showed huge signs of weakness, but in the most recent month, they seem to be showing signs of strength, but they're also coming off very low lows. So when we look at the scorecard, I think it's possible that we look at this and say, wow, everything looks negative. But we know that there are many signs right now that the economy could in fact turn around. Now, I think the ultimate question is how quickly does that happen, and where does the coronavirus go from here? It's possible the coronavirus gets back in the way, although I think it would be very difficult, not just in the United States, but in many countries around the world, to reclose things down. I believe that many governments have seen the economic impact of shutting things down. So I think if things do open up all the way, outside of maybe pockets of different countries, it'll be very difficult to do the kind of shutdown that we recently did. Now, personally, I think that the next video in this series is going to be a very interesting video. I'm most curious to see, do the economic indicators that we've looked at, do we see them just eke forward once more in the next month, or do we see a nice burst? Obviously, we want a nice burst in the right direction for as many indicators as possible. Now, this brings us to the question, do we invest now or wait for the stock market to crash once again? And I think the answer should be broken into two parts. First, if we do dollar cost averaging, then we should keep right on doing just that. Dollar cost averaging is when we consistently invest every week or every month or whatever the time period is. And I think this is a great strategy. The other side of the coin is if we like to pick individual investments. If that's the case, I think we need to be very careful and very selective at this time. I think we need to wait for individual investments to get below our calculation of their fair value. I don't think that now is the time to jump the gun at all. After all, the stock market has been on a crazy run, a much better run than I would have expected. Now, we may ask the question, why are stocks rising as much as they have, even though we're only seeing minor improvements in the overall economic situation? And I actually did a video talking about this very topic, about why are stocks rising. Perhaps that could be a good next video for you to watch. If you're curious, I got a link right here. I got a link in the description below. And I want to thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thanks, and I'll see you in the next video.